Hey everyone, welcome to another video on my channel sponsored by Delta Exchnage, and today in this video we are going to look at is it worth buying the dip. As you all know, market has seen the worst fall in 29 years where we have continuously closed in red for 5 continuous months, and this is the 6th month which we are headed on to, and we don't know how exactly it is going to end, but the selling pressure is very heavy in the market. So in this video we are going to see statistically is it a good time to buy the dip. So we are going to go back to history, see how the valuations of market has been, and is it a good time to start buying now. So markets might be down because of various reasons. It can be due to FII selling, so Trump tariffs, whatever it might be. So that is secondary, but we are only going to see based on the data. So this is going to be a completely data-driven video. And if you like more such videos, I would request you to hit the like button and subscribe to my channel. I have also attached the link to the Excel sheet which I'll be using in this video down in the description below. So make sure you check that out. So before moving on, I would also like to tell you about QuickAlpha's learning path. So we started this initiative with an idea to see systematically if people will be able to beat the market both in options and equities. The first batch is starting this Friday on 14th and 15th of March. It is going to be a 2-day offline session where people will be coming here. So we are going to understand your relationship with money, and we are going to design equity and option systems sitting with you. Post that, we are also going to measure for the next 3 months whether the systems what we have built is helping you in your trading journey or not. You can also be a part of this program. Simply go to QuickAlpha.in and register. So today in this video, we are going to take a look at whether market is worth investing or not at the current valuation. This video is going to be data driven, and I have already done a lot of data crunching which I'm going to present to you. So if you take a look at the market over the last 1 year, so the market has almost returned zero. So this is Nifty 500 what we are looking at, and right on charts you can see the return for the market is almost nil. So there might be hundreds of other reasons why exactly the market has fallen. It might be due to FII selling, it might be due to Russia-Ukraine war, it might be due to Trump's tariffs, so whatever it might be, but unfortunately, our market is one of the worst performing markets across the globe. If you take a look at it, till the period of September 2024 or October, so we were one of the best performing markets out there. So we had outperformed the entire globe and we were actually running on top. But post October 24, so there has been relentless FII selling ever since SEBI started to bring in some changes in F&O. So after that, so our markets from almost the best performing index has now come to the worst performing index, and it has been only few of these indices which are actually hitting 52-week low. If you take a look at it, most of the other global indices are actually hitting 52-week high, whereas our indices is hitting 52-week low. So is this market currently having value is something we are going to discuss. So first, let's take a look at this Excel which I have already crunched. So here I am using Nifty 500 data. The reason is because I believe Nifty 500 gives more accurate representation of both large cap, mid cap and small cap. So Nifty 50 on the other hand is only going to show us the picture of large caps, whereas Nifty 500 is a broader index and it is going to give us a more accurate picture. So here I have basically listed down all the 500 stocks of Nifty 500, and we have also put down how much they have actually fallen from 52-week high. So when you have a look at this, you can see nearly 96% of the stocks, or 95.8 to be precise, is down more than 10%. So nearly 80% of Nifty 500 stocks are down nearly 20% from its 52-week high. And similarly, nearly 60% of the stocks are down more than 30%, and nearly 30% of the stocks are down more than 40%. And this number, to be honest, is very big, because generally whenever the market corrects, so we have seen markets fall by 10%. So even to an extent, we have seen markets fall to 20%. So whenever the stocks are correcting more than 20%, we call it the stock is in a bear phase, or it is a bear market whenever we fall more than 20%. But if you see majority of the stocks, right, most number of stocks have fallen more than 30%, and this is something really concerning. So if you take a look at it, you can also see, right, so right from here, the list actually starts from here, starting from Zomato or Apollo Tires, where the stocks are down more than 30%, and the list just goes on. So most of these stocks are actually down 30%, and the worst stock is actually down nearly 71% from its 52-week high. So this also includes large caps like ACC, Tata Motors, and much more. So it is not just in small or mid cap what we have seen the crash. So these two numbers are pretty much concerning because it shows that the sentiment is really bad, because more than the majority. So if you take the majority, it's 50%, but nearly 60% are going more than 30% correction, right? So that way, if you take a look at it, so it's not a surprise that Nifty 500 has actually corrected nearly 20% from its high. So if you take a look at it, its previous high was nearly 24,573, and from this point, from 24,573, it had come down to nearly a low of 19,681, so which was almost close to around 20%. So even in Nifty 500, majority of the weight is given to the large cap itself, but in spite of that, so small cap and mid cap do influence the movement of this index. So broadly, you can see that. So here we have seen a massive price correction in Nifty 500. So if you take a look at the current PE ratio of Nifty 500, so I will come to screener right over here and go to the PE ratio section. So you can see the last 1 year median PE ratio has been around 25. So the 3-year median PE has been around 23, and the 5-year median PE has been around again 25, and the 10-year median PE has been around 26.7. So broadly, if you see, the overall median PE is around 24 to 25. So across time frames, be it 10-year, 5-year, 3-year, or 1 year, right? So it's around 24, 25. But currently, we are actually around 22.5. So if you take a look at this PE ratio, so we are nearly 10% below the median PE ratio across long term. So I'm not just taking for last 1 year or 3 years. So if you take even for 10 years, or even if you take from the very beginning, so you can still see that the median PE has been around 24 to 25. So across the period, when you look at it, so you can still say that we are somewhat cheaper than the average. So just because we are cheaper than the average doesn't mean that we are bottoming out. So you can see right over here, during the time of August 22, so we had actually gone down to lows of 19. So there was also a time when we had gone to a low of nearly 20. So during the time of February 2016. So this way, many a times we have actually come down. It is not that so we actually bottom out at 22 or 23. So we have gone down well below the average. And there are also extended periods where we have traded above the average P ratio. So that way, when you take a look at it, so our markets currently are at a fairly valued zone. So we are not overvalued at all. So in many cases, you can call it a slight bit of undervaluation because we are well below the average PE. So when we also do some further analysis, right? So you can see that over the last 5 years, right? So 18 stocks over the last 5 years have delivered negative returns, and 85 stocks, that is nearly 20% of Nifty 500 constituents, have delivered negative returns over 3 years. And nearly 272 stocks, or more than 50% of the stocks, have delivered negative returns over the last 1 year. So again, this is not a great sign at all. This just shows how bearish the sentiment in the market is, because over the 3 years, you expect most of the companies to actually grow. And last 3 years has been fantastic for most of the companies, and you expect them to do really well. And if you're seeing nearly 20% of the stocks in Nifty 500 have delivered negative returns over the last 3 years, it is not a great phase, to be honest. So the thing is, here we have to also take a look at one more thing. So along with how much we have actually fallen and whether we are fairly valued or not, we should also see, on the other hand, is our earnings really growing? Because end of the day, if the earnings of the companies are growing, eventually the companies will start to become more and more cheaper, right? So Nifty 500, if you take a look at the EPS, over the last 3 years, Nifty 500 EPS has grown at an average of 12.5%. Over the last 2 years, it has grown around 15%, and last year it has grown by nearly 12%. So on an average, so Nifty 500 EPS in general is growing nearly by around 12% every single year. Along with that, you can see the price returns also. So this is as of today. So if you take a last 3-year price return, so it is almost equivalent to how much the earnings has grown. So as you can see, the earnings has grown nearly 12.5%. The index also has grown nearly 12.5%. And in the last 2 years, again, you can see right over here. So the EPS of the Nifty 500 index has grown by 15%, and the price also is nearly grown by 15%. So that way you can again see, so we are not really overvalued, so we are fairly valued. But in the last 1 year, the price has grown almost nil, whereas the EPS has grown nearly 11%. So this doesn't really account for anything, because this just shows over the long term we are growing as much as the growth of the EPS. And 3 years, 2 years, we are almost matching the growth of the EPS in terms of price returns. So that way, so the market actually looks pretty good. So now, if you take a look at it, so going forward also, our market is expected to have an EPS growth rate of anywhere around 11 to 12%. So this means if our EPS grows by 11 to 12% every year, so overall our market valuation is also going to come down if our market doesn't go up. So for example, so currently we are having a P ratio of 22, and assuming that over the next 1 year the market does not go up and our EPS is actually going to go up by say 10 or 12%. So automatically our P ratio is going to drop to 19, making it one of the cheapest in the history of Nifty 500. So you can see the last time we have hit below 20 is only 3 times over the course of last 10 years. That is one during 16, one during 2020 crash, and the other time during 2022. So these are the 3 times where we have actually gone below 20 PE ratio. And this is going to happen if, assuming that over the next 1 year, the price doesn't go up and the earnings actually increases by 10 to 11%. So will that happen? The probability is low. So that means investing at this point will give you a very good risk to reward. So if you also take a look at in this website trend line, so you can see how the EPS has grown. So let me just put all. So this is Nifty 500 EPS, the blue line, and also the pink line is Nifty 500. So you can see that so whenever the EPS growth has been faster than the price growth, eventually the price of Nifty 500 has caught up with the EPS growth. So in the long term they do catch up, so one will catch up with the other. So not that it will be giving you a linear return. So as we all know, market usually gives an exponential return. So we are going to have our ups and downs. So in case if the EPS is growing faster than the markets eventually catch up. It might take a lot of time to catch up, but they do catch up. So you can see every time either the market has outperformed or EPS has gone or grown way more than the markets. So eventually they have come back and caught up with each other. So that way, if EPS is growing, that means the market also has to start to recover. So risk to reward wise, it absolutely makes sense to actually start investing. So if you have already invested, then again statistically you have a better chance of making money by holding rather than selling your stocks. So broadly, when you take a look at this entire thing, so it just shows, so market generally undergoes cycle and the cycles do change. So the thing is, just because we are at the median P or below the median P, it doesn't mean that the market will start going up. So the thing is, the entire fund flow or entire market movement is driven by fund flow. And this fund flow really happens based on the attractiveness of the entire global markets. So what do I really mean by that? So you can see that right over here, I'll come to Nifty 500 itself and put the max chart. So you can see from 2008 up until 2016, in general, our markets were valued lower. So the average PE was somewhere around 17, 18, 17, 18. So that can be clearly seen right over here. So from 2014 onwards, so you can see our median PE is nearly 22 to 23. So what really changed? So how suddenly from average P of 16 or 15 or 17, we came to 23 or 24. So the reason for that is generally the fund flow. So the more attractive Indian market starts to become, so it will be paid a premium and people will start bringing in money, and as it gets cheaper, they will start buying it. So similarly, if the globe, so the markets around us, if they start to become more attractive than India, so then obviously the money will flow out. So our markets will start to get valued cheaper and other markets will start to get a premium. So currently, if you take a look at it, China's growth has completely slowed down. So if you take a look at it, so China GDP growth. So if you take a look at it, so this is the green line. What you see here is growth rate of US GDP, right? And this is China's GDP, which has not done much in the last 2 to 3 years. So 2022-23 has mostly been flat. 24, it has seen some growth. So broadly, while the US has substantially grown, right? So China is not doing that well. So European markets, needless to say, so their growth rate has been subdued for a very long time. So other Asian markets, there are some emerging markets which are looking attractive, but more or less, if you see, so something solid, something developed, something fast growing is even today continues to be India. So that's the reason. So there might be a premium price paid for India, but this premiumness can go if other markets around us start to become more attractive, start to grow much faster, the economics of these nations or economic policies in the nation start to become much stronger. So funds can flow from India to these other nations, thereby giving a premium to their market over our market. So these move in a cycle, and the cycles can sometimes be really, really long. So best example is that of Japanese market. So if you take a look at Japan Nikkei index, so if you take a look at the Japanese stock market, so this is Japanese stock market, which has almost delivered zero returns from 1990s. So it has been nearly 30 years since the index has given any return. So if you take a look at the GDP, so you will exactly know why. So last time they almost peaked out in 1995. So post that, their GDP has actually seen a dip. So from 1995, they have not really grown at all. So this is a classic example of how the fund flow can totally change the country's premiumness. So in case if the country stops growing, so we will see that our markets will naturally start to get valued lesser and other markets will start to get a premium. And currently, to be honest, I don't see that happening because we do hold a very strong global foothold. So we are almost heading towards $4 trillion, or even very soon we are likely to be around $5 trillion. So we would be definitely one of the strongest and fastest growing economies out there. So that way, I do feel right now the markets statistically, because most of the stocks have come down well over 50%, well over 30% from their 52-week high, it just means they have unlocked more value. Overall, the market too looks pretty fairly valued when you take a look from the statistical standpoint. So I'll also be attaching this Excel sheet down in the description. So I hope that you liked today's discussion on how exactly our markets have unlocked value, and I hope that you have got some insight from this particular video. So in that case, make sure you hit the like button, share this video, and also follow me for more. Thank you so much for joining, guys, and see you soon in the next video.